Variable rate mortgages have jumped and rates on those mortgages have jumped in the wake of interest rate increases here in Canada, and they're set to rise even further. That may have some homeowners considering whether they should convert to a fixed rate mortgage. But our next guest says that's not a foregone conclusion. Let's talk now to James Laird. He's co-founder of Ratehub.ca. James, thanks a lot for joining us. It's easy to understand the discomfort that holders of variable rate mortgages would feel now. The Bank of Canada set to raise rates, almost universally expected to bump them up by another 0.75 of a percentage point next week. What are some of the factors that mortgage holders need to understand before making the move to a fixed rate mortgage?
Yeah, morning, Paul. Thanks for having me. So I guess the first thing to understand is that you can, with any mortgage lender in Canada, you can convert from a variable to a fixed rate mortgage at no cost. Now, you do have to stick with your current lender. If you look to switch to a different lender, you will have to pay a penalty to leave the existing lender. Your current lender will offer you a term that's the same or longer than what you have remaining with them. So, for example, if you have 3 years remaining in your variable rate mortgage with your existing lender, you can expect that lender to offer you a 3, 4, or 5 year fixed rate mortgage to lock into. Also important to note, Paul, that you would not have to re-qualify when you're doing this conversion from variable to fixed.
Interesting. I'm looking now at the Ratehub.ca screen, the page which outlines the best 5-year fixed rates in Canada. And they are rates that range from 4.14% to 4.94%. So between 4 and 5%. None of those lenders are major Canadian banks, which I guess is typical. How do variable rates compare to those rates that we've just outlined? Again, those fixed rates, 5-year fixed rates ranging, broadly speaking, from just over 4% to just under 5%.
Yeah, so you can still get a variable rate mortgage for 2.5%, between 2.5 and 3, before this increase next week. So the spread between variable and fixed is still quite large, about 200 basis points. So that's how much it will cost you, Paul, to convert from a variable to a fixed rate mortgage, which is why, even though we have a lot of variable rate consumers in the country, not everyone is converting to a fixed rate. They're taking a longer term approach. They're thinking, I'm going to pay this mortgage off over 20, 25 years. And over the last 20 years, the variable rate has been the cheaper one to go. And it is still cheaper now. So I'm going to stick with the variable rate, knowing that historically speaking, it has been the cheapest way to finance homes in Canada.
Can a homeowner then sometime in the future switch from a fixed rate to a variable rate?
Excellent question, Paul. And you cannot do that. Once you're in a fixed rate, you're fairly stuck. And fixed rates do have much larger penalties and less flexibility than variable rates. And if rates do happen to drop in the future, then those fixed rate penalties can be quite large. Years ago when rates went up and then came back down, fixed rate mortgage holders who looked to break, they would have $10,000, $20,000, $30,000 penalties. So we are seeing a lot of consumers stick with the variable for the flexibility as well.
Penalties of between $20,000 and $30,000 for moving out of a fixed rate mortgage. Is that correct?
That's correct. And that is, Paul, it's only in the case when the market rates drop. So, let's say we get up to 4, 5, 6% on the fixed rate side, and then, maybe we get into a bit of a recession. We see fixed rates come down. That's what creates the really, really large penalties. When rates rise, if they continue to rise, then it's just 3 months of interest, whether it's a variable or a fixed rate. But if you break a fixed rate when the current rates are lower than what you have, that's when those huge penalties are created.
Wow. Explain to us the system of transmission, if you want to call it that, that begins with the Bank of Canada raising its benchmark interest rate, its so-called overnight rate, to the variable rate mortgage. The next day, or often within hours, we see one or two of the major Canadian banks raise their prime rates. The other major banks always follow suit. And it's not long after that, correct, that the variable rate mortgages go up?
Yeah, so anyone with a variable rate mortgage or a home equity line of credit, which is also based on prime, they can expect their rate to move quite quickly. We see the banks when rates rise, we see the banks react very, very quickly to pass along those increased rates to consumers. So anyone with a variable rate mortgage or a home equity line of credit should be budgeting for what their payment looks like once this assumed 50 or 75 basis point rate hike occurs next week. They should also be budgeting for the rest of the year for another, let's say, 50 or 100 basis point rate increase to their variable rate payment or their home equity line of credit payment. Of course, people with a fixed rate mortgage right now, if you're partway through your term, this announcement next week will not affect you. But if you do have a renewal coming up, in the latter half of this year or early 2023, you should also be calculating your payments based on the new rate environment that we're in.
Stock market professionals often advise investors to think seriously about their risk tolerance, because your portfolio construction depends on your ability or your willingness to tolerate the significant risk that is in equity markets. That's a big part of this equation as well, isn't it? Homeowners need to think about their risk tolerance.
Certainly. Anyone with lower risk tolerance or tight household finances should already be in a fixed rate mortgage. A variable rate mortgage, it carries more risk. You are fluctuating with the market, and that is only appropriate if you have, some excess funds and you could handle it. If rates continue to rise, maybe they go higher than economists are expecting, you need to be able to handle those types of payments. So yeah, fixed rates are appropriate if you're more risk averse or if the household finances are tighter.
James Laird.